Hi, everyone, and welcome to Investing Counterpoint. I am Jan Perillo, CEO of Extrema. And today I'm excited to have this time with you to discuss areas of risk affecting portfolios today and those that may be on the horizon. And today I have a great guest with us. It's Max Wasserman he's the founder and senior portfolio manager of Miramar Capital in Chicago. And, we had a little bit of a pre-talk before this recording here. And I think you guys are going to really like this show. So Max, thank you so much for joining me today. And maybe what you can do quickly is just give me the 30-second elevator pitch about Miramar Capital, because I think you guys are actually, really an interesting company.
Thank you for having me. Yeah, so make it quick and simple is we manage portfolios the old-fashioned way. We build individual stock and bond portfolios for the high net worth clients, institutions, foundations. We pick the stocks, we pick the bonds, and we construct the portfolios. We usually have an equity portfolio of about 25 to 30 names of dividend-paying stocks, and we invest in investment grade bonds only. And we tailor the portfolios to meet the risk of each client, the risk tolerance for each client and their time horizon. But we're the old-fashioned ones. We don't outsource it. We do the analysis. We kick the tires, listen to the calls. We do it ourselves.
You talk to the CEOs and everything?
Yes, we do. We call them in when we can get them on the phone. It's not an easy task.
Yeah, I bet. So, one of the things that we were talking about prior to recording here is, and it dovetails very well with our audience here is how you guys look at risks. And when you guys are constructing these portfolios, you take those, 30, call it, names of stocks, and then you have some bonds, and you will construct your portfolio specifically to that risk profile or tolerance or desire of that high net worth client or foundation or whatever it might be. And so you use different mixes here. So when you guys do this, like, kind of how do you look at constructing those portfolios in terms of the risk profile of the client? What's your process there?
Sure. First thing, you really want to understand what the clients want to do with their money. I mean, most of our clients are wealthy and they want to stay rich. And a lot of them may even want to live off the income of the portfolio. They may want to leave it to a beneficiary, a next generation. So it's really trying to narrow down what the time horizon is for the client. Believe it or not, you can have an 80-year-old client who has an indefinite time horizon because all the money's going to their children.
Right.
You could have somebody in their 60s who need to live off all the investment income.
Mm-hmm.
So what you do is you match the time horizon with the client's needs, what type of income they need, what their tax considerations are, liquidity. Anything you do is unique to the client. And based on that, we'll put together, an objective for the client. Is it more income? Is it more growth? Is it a combination of both? And what is the asset allocation that fits that client? But regardless of what the asset allocation, if they own stocks, they're owning our best, let's say 25 to 30 dividend paying stocks. And those are our best ideas that will go into any portfolio that holds equities.
Now, do you mix? And so if I'm much more conservative than another client, do I still own those same exact 30 stocks, or do I own like just a subset of that most conservative 30 stocks? I mean, does every client hold every stock in different mixes, or how do you look at that?
Sure. So, again, when you say the word conservative, we invest in conservative dividend paying stocks. Right. We think that fits in their portfolio, especially since the average dividend yield in our stock portfolio is 3% and grows roughly about 8 to 10. But it's 30 names. If we own them, now if a client comes in with new money or adds to it, they may not get all the names at the same time because we're very price sensitive.
Right.
But in the end, they're going to own the same portfolio. Now, if you sell it, the stock, you're going to exit it, or you're reducing it, you may not own as much. But basically, we don't do a subset. These are our best ideas. I'm under the philosophy that you're always rebuying your portfolio anyway. So if you have it now, then I assume it's still going to be good for the next 1, 2, 3, and 4 years. If it's not, then maybe you shouldn't own it at all. So again, but it is the same portfolio, 99% of it.
So your philosophy is much more that on that buy and hold type of philosophy. You guys aren't churning the portfolio. You guys keep things for a long time and things like that. So when you're evaluating these stocks, how do you look at risks on the horizon? Because I've heard you talk on a bunch of other channels and things like that. And there's all kinds of geopolitical risk. We talked about inflation risk. We talked about yield curve risk, all these different risks that are out there. How do you guys approach that?
Well, first, we want to understand the companies, right? And that's really a big thing. We try to stay in our area of competency. So I'm not a master. I'm not going to go into the Bitcoins. I'm not going to go into certain microtechnology stocks that I don't understand or healthcare companies we don't understand. So we're going to narrow the scope to a universe of high quality dividend paying companies. So it's pretty easy for us to identify a company that has a strong dividend policy. That's the number one thing to us. They got to be a shareholder friendly company that states it. And are they consistent with it? So when we look at companies, we're looking for their ability to pay the dividend and grow the dividend through the whole economic cycle, not just a good year or a bad year. We want to see that. And we want to see how the company talks about the risk, right? I mean, we talk about the macro of where we see, China, Taiwan, or the Ukraine,
Right.
but what's the real risk facing the company? And when you go to that level, a lot of times you'll find those are not issues for them. Basic issues for business affect these companies. That's where we want to focus our time. And that's where we focus. But we try to understand the fundamentals, the catalyst for the company. Is the market share growing? Are they taking more market share? Are they losing it? Are they taking on more debt to finance dividends or stocks or whatever? Yeah. We want to understand the capital structure of the company and the philosophy.
So when you say, kind of like looking at how they've approached this through good times and bad times, so one of the things that we've seen is we have really, if you think about back to 2009, we've had mostly a bull market up until, last year, really. And so you've had really good economic cycles for companies to operate in, low cost of capital, things of that nature. Kind of getting your head around how management is going to manage the, their balance sheet going forward has got to be an interesting. I mean, it's got to be kind of difficult because they've had one environment through this entire cycle that you can really look at for the last 10 years, and now it's going to be something different going forward.
Well, you start to look at how they do their debt structure. When you look at these companies, are they issuing more debt to buy back stock because there's no cost of capital, right? I mean, the cost of capital is everything. We've had an environment, and most managers don't understand this, to be candid with you. This has been zero interest rate financing for everything. So you've had huge multiple expansion in these growth companies. Not to get too technical, but you're discounting back future cash flows at 0 to 1 to 2%, no risk to it. Now, all of a sudden, you're discounting back and you're adding a risk premium. So now if you have a 10-year 4% or 5% plus a risk premium, those cash flows look expensive. Mm-hmm. What we see with companies, though, is how they are structuring their company 3 to 5 years out. When you see a company, for example, that's issuing a lot of debt to buy back their stock because the top line revenue is not growing, that's a clue. It's a cue to us to watch it. Or if you're seeing companies that basically it's all zero interest financing that's running their company, and a growth stock, then it tells you something. Mm-hmm. But companies will tell you, they'll tell you if they're buying back stock. They'll tell you if they're increasing their dividend. But we look a lot at the cash flow statement, right? That's good. But we go back to the cash flow statement and we want to see where the money's coming in, where's it going out, what's really happening. I want to see what the patient is really doing, right? Not what he's just telling me. I want the EKG. I want the blood workup. I want the whole thing.
You want the hard work because that is the most unuser friendly statement out of the three. If you think
it is, I mean, I'm telling you, I want to see, where that cash comes in and where is it going out, and then we'll run our own little test. Like, well, if they're doing a lot of debt financing and that bond is coming due, a big tranche of the bonds are coming due, and they have to refinance. Well, then they can't meet that future capital expenditure that they want.
Right.
And by the way, we're seeing that now in a lot of companies that are cutting their dividends, or we see that a lot in companies that are delaying, buybacks because the zero interest rate was free money to them. So, but we have to understand the company capital structure, and you can't just watch it on TV. You got to read the financials. We read the 10Ks, the Qs. I read I listen to conference calls, stuff that make you go to sleep at night. But that tells us a story, and that will help us understand to make better predictions on these companies that when they run into, for example, a stress in China, and their markets are closed, right? Can they really, how soon before it hits their cap, right? Before they can't do it.
So so that's a great segue into some geopolitical type of risks that you must have to evaluate. So your portfolio is primarily US domiciled, some ADRs you mentioned before in our pre-call, but obviously China has an effect on every, US company almost.
Absolutely.
This Ukraine conflict has an effect on many, if not all US companies. So how do you start to look at the geopolitical, because it's impossible to predict, like we know that you can't predict anything with certainty, but you must be looking out on the horizon because you're investing in these companies for 3 to 5, 3 to 5 years. And so, when you think about what is coming down the horizon, like how do you evaluate that?
Well, I'm gonna jump back a second to COVID, right? How do you do it in COVID? So when We were locked down a lot. I mean, it was part of that first exposure where I was shut down in the house, and we were wondering, what could you invest in, right? My partner was, believe it or not, driving around the roads, checking our companies if they were open. Right? Okay, which grocery stores were open? What chains were open?
Interesting.
What anything? If they're open, we're buying. If they're not open, we don't know when they're going to open. We're getting out of it. And that type of thing is in a political, but it wasn't a political, it was an economic shutdown.
Yeah.
We were looking at who could survive it and who was open, who wasn't. Now, if you fast forward to China, you have to look at these companies that maybe 50% of their growth is coming from China. And what happens if they don't turn that supply chain back on as quickly? Maybe it doesn't deserve the premium in the multiple that it's given if we don't see China. We don't see the supply chain. So we do look at it. And, there are a bunch of retail apparel companies we had investments in that we've lost some money, made some money. I mean, you can't help it. But you see them getting hit because the big China growth market, nobody's buying Starbucks, right? When they shut down, nobody's buying the Nikes. So if that's 50% of their growth, then you have to factor that into the valuation of the company.
Of course, yeah.
Same thing with oil prices, right? Most people don't understand how much oil affects every day, even to diapers, right? I mean, the cost. So what is that going to have on commodity costs? And it's going to pinch the margins. So we do look at that. Right now we see political risk, but we see a bigger risk of inflation and stagflation, believe it or not. This China issue, you cannot pick when you're going to have, God forbid, a China-Taiwan, which I would tell you would be a massive problem.
Massive.
That would be a massive problem.
Agreed.
China.
Yeah.
The Ukraine issue, while it's very unfortunate, it's really not affecting the oil market as much as everybody loves to tell you. Unfortunately, we have not had an energy policy consistent for a while. And I'm not take political sides either way, but you can't stop producing oil. We stopped, and then when the demand wasn't there, it was great because nobody's going out driving a car. But now the world's turning back on, and your production levels are the same. And what people forgot about 8 years ago, these companies were on the verge of bankruptcy, right? So oil, as we invest in oil companies, we see there's no growth going on in production, which makes these companies even more valuable, and the demand for oil is not going to be met as quick.
Right.
So any disruption or OPEC cutting, like cutting production, we see that and we look at it and we evaluate the effect on the supply demand of oil. But
and
that's how we're looking at everything from that, but we're trying to narrow it down to our companies and our investment.
Yeah, that's really interesting because so you're not so much. I mean, and there is a prediction. So there is like an exercise that you do over. You mentioned China, Taiwan, how bad that would be, and so you must have to. You must kind of run through some of those scenarios in your head, at least, and then say, and have a plan for what these. What if a company's a good investment now? That doesn't mean it will be a good investment in a year if this happens. But as long as this doesn't happen, this is a solid investment. Do you come in across those scenarios a lot where you have to have these kind of different paths given?
Oh, absolutely. I mean, when we look at China, Taiwan, we look at instability around the world. That tells us we like defense companies, by the way. And most people don't realize that they're nearly not as regulated, directly correlated to who's in charge as people think. I mean, it's an oligarchy of a market. There's a handful of that. And the more you keep sending arms or ammunition, believe it or not, is running out to the Ukraine or anywhere, the demand is there.
Yeah, right.
And if you see, as we do, that we see instability sort of here to stay, right? And we're taking that scenario. So we paint the picture. So we do like defense companies, and which ones? Where would we like to be? Where do we think do we need submarines, right? Which companies would like to produce submarines? Not getting specifics, but we have a company that we like to do that. Abrams tanks, things of that nature. But we also say what would be the effect, right, on a shock to the system. And when we do that, or if we can't find a resolution, we'll get out of a company, to be candid. If we can't see it with some conviction, then we're not going to stay. And when you come into conflicts, I would look at it a little bit even different. Don't look at anything we discussed prior. If I know about it, I'm not nervous, right? It's the event I don't know about, or the event that's being dismissed. So my partner and I, we like to hit it and say, what if we're wrong, right? What if we're wrong about the banking issue, right? Who do we want? So, I mean, literally, we go through and we look at the balance sheets of all the banks that we like, and we look at what's their unrealized losses potential, right? And what would happen. And we'll pare back in areas, right? Or we'll take advantage of.
Well, I think one of the things we talked about earlier was, and you said this, and we agree, we've said this on our previous episodes too, is that volatility isn't really risk. I mean, volatility is a known quantity, right? I mean, if you're investing, you're taking some assumption of volatility on in your position. The more volatile, the more you expect to get paid, sure. But volatility isn't really risk. So you're talking about the risks to the sources of cash flow, the sources of financing, the sources of like the things that really make the company tick, and some of these other things which are geopolitical, which might be outside the realm of a traditional financial analysis, but that can really affect all of those inputs into the company's finances that really make that company a good or bad investment. So you really need to understand all those different levers.
Oh, absolutely. If you don't understand that supply chain interruption could go on longer because of China's lockdown, or if the Strait of Hormuz is like over an Iran issue, that you could really disrupt oil. If you don't understand that, then there's no way you can model out and make, because it's a probability, right? We're all making probability assessment. What's the probability of this happening versus that? But if you don't understand the issues, you can't even go that far. So you need to have a geopolitical outlook, if you will. And mine and my partners in our firm is the fact that instability is here. Embrace it. And what I mean by embrace it is the world's not coming to an end. You take the attitude, if you believe the world's not coming to an end, right? So doomsday clock, if you will, and you're going to have ups and downs, then an investor wants that. I mean, investors should be rooting for temporary volatility that crushes a market 5, 10, 15%. Because if you're a truly investor, you're going to buy a good company on sale. That's not structural to us. We look for structural changes. 2008 in the banking industry, that was a structural problem. Inflation in the 70s, a structural problem. If the banking issue now became a structural problem, if oil became structural problem, we're looking for structural changes in the system because that takes a volatility from a short term and makes it a long-term problem. Right. And that's what we're trying to ascertain is volatility in the Ukraine due to a war. Is that volatility or is that going to be a structural problem? Is there temporary shutdown potentially over the votes on the Treasury? Is that structural or is that temporary? Yeah. Right. So we're really trying to see what is structural changes because that's really how you make money.
No, that's interesting. So we were asked fairly often, I would say, can you do a scenario for a nuclear war? I'm like, if we have a nuclear war, who cares?
Exactly.
I mean, so
that's at least your problem is what happened to the market.
Yeah, exactly. That's the least of your worries. You need to. You're talking about things like, okay, a conflict, like things that are like if inflation stays high for long, that could be a structural problem in the U.S. Interest rate policy in the U.S. is different. That could be a problem for these companies that you're talking about with a mismatch of assets and liabilities. So these are problems that you can kind of get your head around and potentially take advantage of if you can understand them.
Yes, I mean, people don't realize that the bond market it dwarfs the stock market. Yeah. Right. The currency, it just dwarfs it. I mean, but we like to talk stocks because it's hip. If it's every here's a great idea. Your stock was up 88% for the year or something like that. Nobody wants to talk about it. But the real action is in the bond market, instability, because that's how everybody finances everything. But if you look structurally in terms of where we see risk, stagflation is a big structural issue because what happens right now if the economy slows down, but the inflation's embedded. I mean, unemployment's still not changing. I mean, your rate is 3.5, 3.6. It's even though they say all these layoffs that you're seeing in technology, the unemployment rate in the technology sector is 2.2%. So even the people you see losing their jobs, they're finding new ones quickly. Yeah. So there's an embedded inflationary number in wages, and that's going to affect it. The companies are telling you that, right? And you're starting to see it. You're seeing if you had a problem with the treasury market or the bond market, or if what's happening with the SVB bank or whatever, which in our opinion was bad management, really was bad management and bad oversight. But it's not a structural problem. And by the way, that's a right of a pen. I always tell people, they can change that by just saying that unrealized gain get held to maturity, right? And the Fed has already said, the Fed has already said we're going to guarantee most of the stuff, 100%, whatever. So, but I'm saying that's headline. Structural changes if you see China going to Taiwan, and all of a sudden we're drafted into a war. If you had a Middle East problem, right? If you had an issue that disrupted the oil supply, that could be structural.
Especially now that they just cut and we're kind of at that pretty delicate supply demand balance there with
We're not getting away from fossil fuels, contrary to what we might hope for. it's just not happening because we don't have the infrastructure to do it. I mean, we don't. So energy policy is an issue, but there's a lot of risk that's manageable, but it's headline risk, right? Look for structural things. Look for if there's a real problem in the banking system, which we don't see it. Is there a problem with our energy policy? Yes. But guess what? What an opportunity for people to invest in oil, right? Or fossil fuels, right? It hasn't been looked at in a long time. Remember, nobody wanted fossil fuel stocks like 2 years ago. You couldn't give them away. Right?
Negative oil, especially, and negative oil prices.
Exactly, right? You couldn't give it away. I tell people, and we talked about this, risk to me is really losing principal, not a fluctuation in value. We are going to have it. I cannot tell you if, Congress does X or if we find, God forbid, a tax somewhere. We can't do that. But if you take it back and say, is it really a structural change? That would help me make a decision. If the banking system in these two banks, three more, it really became an issue, then that could be structural. But it's not even close. The banks are in really the best shapes they've been in a long time. If actually the bigger have gotten bigger, which is not what we wanted, but that's what happened. Actually, cash flow on the corporate accounts are really big. Right now, the biggest risk is I think there's a mismatch in valuation with what the Federal Reserve is doing. I mean, this is if you want to know to me in risk, if I could throw something out there, our opinion is that the market right now is betting that the Federal Reserve cuts interest rates, and the market's up 6-7%, but it's really 3 to 4 stocks. 3 to 4 stocks is count for the whole thing. It's equally weighted. The S&P is only up 1%. We tell people risk is when you jump in and you expect, this outcome that's based on weak legs, if you will. To us, technology can be a risky area when you're spending 30, 40, 50 times, right? In a rising interest rate. That's ridiculous.
It's interesting. You're kind of like everything that you're discussing makes me think that it's a difference between trading and investing, right? Like when you're trading, you're kind of trying to take, kind of quick advantage of these small dislocations. When you're investing, okay, well, I can't see that coming over the next, it might have a little bit of a downside here and there, but over the long term, this is what's going to, this is what I believe is going to happen with a company like this because of all these bigger issues versus, trading and trying to get out in the next couple of weeks or something like that.
Yeah, I don't know that many traders who remain wealthy for long. Everybody's a genius in the short term because the market, they caught it right. But if you look at investing, it doesn't mean we don't sell stocks. I mean, our turnover is like 25% in the portfolio on average. We get rid of it. But it just means that you look at the world different, right? Like you said, the world's not coming to an end. So I'm not going to react every single time a headline news comes out that makes me think, oh, the government's going to shut down and not going to pay, or, Ukraine's problem's going to get out of control, right? Russia's going to go through the Ukraine, go to Poland, go to Germany, and it's all over again. Now, it doesn't mean things can't happen, but a true investor is looking at longer term than 3 to 6 weeks, 3 to 6 hours. Because again, our clients are very wealthy. They made their money. And your viewers, if you make your money, you don't want to lose it. Right. So the key thing, a risk we haven't talked about, and is really a really big risk that nobody talks about, is people are outliving their money. People have living longer, and they wonder, you save money, your earnings years, 40, let's say 40s, 50s, and then into your early 60s. So you have 15 to 20 really high earning years. I'm going to be generous, but it's actually 10 to 15. And then you're retiring 30 to 40 years. People are living longer, healthier, and they're realizing, wait a second, I didn't expect in 80s, I'm still hitting a golf ball. I have the hip replacement, right? I didn't realize I could do that. So people need more money. And so what they do is as they get older, people are like lowering their exposure to growth, right, to stocks. They say you should buy bonds, but bonds can't keep up with inflation. So the real risk to us, a real central risk, is you outlive your funds.
Yeah.
And it's hard to tell somebody because they think, I'm not going to live till I'm 80, right? I'm not going to live. But when you do, you're like, wait a second, I can still move. I can still move around. So that actually number one risk to us is people outlive their money. That's, I know it sounds silly, but
no, I most of my career was in pensions. And so, I did risk management for pension funds. And so the big thing that we always talked about was longevity. And I teaching a course and I said, basically right now, whenever you have actuarial changes about, longevity risk and inflation and growth, like that never goes in the favor of the sponsor of the company, right? That always goes up. It always goes up, and there's a reason for that, because your people are living longer. Even though I know we had this the dip in COVID, but that's just that's a different thing. I mean, people are living longer. The cost of retirement is always more expensive than what you think it's going to be.
And everybody always says, when I retire, I'm not going to spend as much. Believe it or not, they actually spend more than when they were working, because they're filling up their time. So the biggest risk is, and by the way, time is an investor's best friend. But it's not sexy, right? I mean, think about it. If we're talking risk, and I'm mentioning longevity risk, yet I've got I got oil problems, right there, yeah. Right? I sound like this guy doesn't get it. The world's coming to an end in oil production, and he's talking to me about 15, 20 years from now, right? I realize, I'm sounding out of touch, but that's just noise. These things I could go back to, and people tell me how bad things are now. You realize we just went through a pandemic where everybody was thinking zombies were taking over the world, right? I mean, the zombie movies, you remember that scene on TV, right? And you lived through that. You lived through 2008. We've lived through inflationary times, right? We've lived through it. So don't get caught up in the noise, right? I mean,
that was already 15 years ago, like you said. I mean, you're talking about this noise. I mean, that was 15 years ago already. We're past it.
Yeah, but I mean, and how many people today you talk to now? It's a question for you. How many people remember COVID even? They're past that now, right? In terms of they're getting out, but the world was shut down, and yet we continued. Thank God we continued. But so a moment in time, and that's these things are like inflation this time, it can affect your portfolio. You have to understand the risk in your portfolio. You have to understand yourself, what type of investor you are. That's the key. I mean, if you have a trader mentality and somebody's talking to you about investing, it's not going to work, and vice versa. And you have to understand what you're buying. I mean, if you truly understand what you own, and by the way, I say most business people, I'm going to say, get in trouble, more educated, what do you want to define as educated, college, not college. People who are educated are good investors when they use their common sense. Like, what do you use? What don't you use? I mean, if you can't pick up your statement and understand what you're invested in, to me, that's risky, right? Because then I don't know.
Yeah, you have no idea.
I don't know what I'm doing.
Well, Max, we've talked probably longer than I anticipated keeping you on, and I know that you have a time constraint, but it was great talking to you. This is a fascinating conversation.
My pleasure. I really appreciate it.
Yeah, me too. And take care. We'll see you next time.
Thank you so much.
Thank you.